we can't look at the world the way we want it to be. We have to look at the world the way it's going to be.
Sustainable investing has taken a hit after the pandemic. We examine whether it's still a worthwhile approach. We've got Amber Fairbanks of Impax Asset Management. She oversees $4 billion in sustainable investing funds and has been focused on this area for the last 12 years.
It's been a challenging time in the US right now. You basically have to defend sustainability.
But do you have to sacrifice returns to be a sustainable investor? What are the right questions maybe to be asking of your AI companies today?
The market, in my opinion, has taken something of a lazy view of software stocks.
Would you ever invest in oil and gas? When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. And we're here at the moment. I can finally reveal what our swag giveaway is going to be for the next month. If you're watching, you can already see it. But if you're listening, it is the market cap cap or the market cap hat. I think that's easier to say. And the liquid assets mug. Yes, it's going to be a 2-for-1. Every single episode, we are going to be giving away the market cap cap. Actually, that is more fun to say. I'm going to say market cap cap and the liquid assets mug. And just to be clear about what a democratic process this was, I did not vote for either of these things. I really wanted the free Jerome Powell mug, but you guys wanted a little bit more literal interpretation with the liquid assets mug. So here's how you get the swag. It's so easy. The hard part is done. You voted. I've made it. What you need to do is be a subscriber, like and comment wherever you're listening. We feed off of it, so please do it. And we will pick one winner every episode and start sending away this sweet, sweet swag. On this episode, we talk about sustainable investing. Yes, we are talking about something that was really popular during the pandemic and seems like it was left for dead. Well, not to Amber Fairbanks. She has spent the last 12 years focused on this area. She runs about $4 billion at Impax Asset Management, and she really uses it as a lens for all of her stock picking. So you'll find names in her fund like Nvidia, which I don't think are obvious sustainable investing stocks, but she'll explain kind of what her criteria are and the fact that she's looking at these opportunities for the long term. And quite frankly, you know, it might have to come at the expense of performance in the near term, because we also examine how this might not be a factor, right? You think about factor investing, it's momentum, it's value, it's whatever. Sustainable investing is something that she says you need to layer on top for the long term. So we go through a bunch of stocks, including software stocks. I also ask her if she'd ever invest in the commodity sector. Her answer might surprise you. It might anger you if you like that sector. So as always, let's get into it. Amber Fairbanks, thank you so much for joining me on the podcast.
Well, thanks for having me.
I'm excited to have another Amber. So already I must know that you're brilliant. Okay, you work at a place called Impax Asset Management.
Correct.
And the layer that you apply to everything, correct me if I'm wrong, is sustainable investing. Is that right? What does that mean to you? Because I feel like sustainability can take on a lot of different definitions.
Yes. No, agreed, especially now. To me, sustainability means just being durable. So being able to be viable over the long term. So we look at opportunities around secular trends and then just also look to manage risks as well, which can arise from a lot of different areas, but particularly around ESG risks is a focus for us.
So it's not necessarily looking at sustainability, you might think the environment, so that you're invested in solar or wind. Does that mean those things are not in your portfolio, or is it just kind of a different layer that you're applying to the S&P 500?
Yeah, I mean, they certainly can be in our portfolio, but that's a really narrow area of the market. We're looking at kind of long-term secular trends, so things like aging population, for example, water scarcity. All of these should provide economic tailwinds for companies addressing those. So it's quite broad with regards to the types of companies that we can invest in and the economic drivers that will support them.
And we're going to talk about some of those ideas. We have a lot of stock-specific questions in the mailbag. And of course, you brought your 3 top ideas. But you've been doing investing for a long time, sustainable investing for the last 12 years. And that has seen, over the last 12 years, a lot of interest. And then, I don't know what you would call it when the interest retreats.
Disinterest.
Disinterest, a bit of a desert. Talk to me about the cycle of sustainable investing from that perspective. It was especially hot during the pandemic, and it really seems like nobody really talks about it anymore.
No, that's true. So I started out in sustainable investing. It was actually back in 2007 as an analyst. And back then it was called socially responsible investing. It was all kind of values-based investing. And then it became this idea that, there are risks and opportunities that affect long-term value of companies. So we talked a little bit about some of the opportunities and the risks. I mean, if you think about it, you look at ESG risks, it's basically so much of a company's value today is tied to intangible assets. So things like brand and reputation. So it becomes incredibly important for companies to protect that by understanding all of their material risks, of which ESG are some. So ESG for a while became incredibly trendy. We saw that. I remember it was fun. It was like, 5+ years of just inflows and great performance, et cetera. And then all of a sudden it just became this idea that for, I think, a lot of firms, they used it a bit as a marketing tool. So it became, a way to put sustainable in your the name of your strategy, but not really incorporate that in a way that added value. It became about, looking at climate trajectories and water usage for things where it didn't actually have a material impact, like banks, for example. So you really lost it as a source of alpha, and it just became something that people tied themselves to because it was trendy and brought inflows. And I think that was really problematic. So you had a lot of people who got involved in sustainable investing, potentially not for the right reasons. They forgot that there was actually a performance component to it, or there should have been. So then when you had tough performance, it was really tough to keep those assets because any strategy is going to go through periods of underperformance. But if you didn't actually believe in and didn't actually integrate that in a meaningful way, then of course you drop that label, for example, or you drop the process that you incorporated to call yourself sustainable. And we've seen a lot of that. I think ESG in the US it's become just a hated topic, right? And it's really performance driven more than anything, because I think if you are a long-term investor, and I do think that, that's really one of the only exploitable sources of alpha in the market today is having a differentiated time horizon, then these factors are really important in terms of driving revenue and managing risks. So it's been a challenging time in the U.S. right now. You basically have to defend sustainability. Mm-hmm. For me, it's, at the end of the day, we can call it ESG investing and we can call it sustainable investing. But considering factors that affect the long-term value of a company, to me, is just investing, period.
What are those factors? What's on your checklist?
Yeah, I mean, I think a lot of it's around kind of the E. So you're looking at environmental risks, and that's just natural because it's the most quantifiable of ESG. But you have to understand what's material too, right? I mean, in water usage for a bank, it's immaterial. It doesn't matter. It's not going to affect the value of a bank. It's around the S, and I think that's kind of the most interesting now.
That's the social part.
Exactly, the social part. It's kind of corporate culture is an area that I find incredibly interesting. It's just trying to identify those companies that have great corporate culture on the idea that they're more innovative and adaptive. They have diversified influences on decision making, and they have more motivated and productive workers. that can be a huge benefit to a company over the long term.
Now, that's really qualitative. In some ways, you can see it. You can look at the percent of women or maybe more diversity on the board or within management if they disclose it.
Yes.
A lot of companies don't. Most companies don't,
right.
In fact. So how do you get a feel for that that factor that you can't read about in a 10K?
Yeah, I think if you look at the trend, there's a lot more social data available than there has been in recent years around things like diversity. But I mean, I think that's only one component of culture. We use diversity as a measure of cognitive diversity in companies, but that's a real benefit is cognitive diversity. Gender's a proxy for that, not a perfect proxy, but probably the best we can get. But I think there are other metrics that you can look at, things like turnover, for example, things like productivity, if you're looking at, say, EBITDA per employee and the change over time. One of the interesting areas that we focused on more recently has been looking at Glassdoor reviews. So what we did, and I'm not going to explain this very well because it was the quant team that did this, but we looked at a couple of keywords, things like agility and customer and respect. And then we used language learning models and used them to identify those words in those reviews of companies and the sentiment around them. So were they being used positively or negatively? And so we were able to take a look at all of the Glassdoor reviews for companies and then essentially score them across those. So were these words being used positively? Were they being used negatively? So it's really an ability to kind of take now the employee data and their sentiment and start to aggregate that and start to better understand culture. Again, we're never going to get a perfect measure as an outsider, but it gives us a starting point.
So you've got a company that has tremendous growth prospects, and then it has a poor S score. Maybe their Glassdoor scores are atrocious. People are complaining about the culture, complaining about toxic workplace. Will you go so far as to not invest in that company, even if it looks like on paper the next 1 to 2 years seem amazing for growth prospects?
Yeah, I mean, it's one piece of the puzzle. I think we kind of want to understand where those reviews are coming from. But if you're a long-term investor, you really don't want to invest in a company with bad corporate culture. You're going to have unethical behavior potentially. You're going to have higher turnover. You're going to have demotivated employees. Maybe that company looks good on a 1 to 2 year basis, but if you're a longer-term holder, then it really doesn't. And it's tough to know when that actually implodes on the company anyway. So it's like maybe you're holding for 1 to 2 years, but there's a high risk. So you have to recognize that.
Now, you've already said that your time horizon is long-term. So this is for investors that are looking for kind of the long-term viability. And so that's where sustainability becomes extra important. I imagine the pushback that you get is that you're screening for factors that aren't necessarily the source of outperformance. So your fund, in some of your funds, for example, you're very heavy on some tech stocks. Nvidia is the top holding, and it's lagging right now, not because of ESG factors, just because kind of vibes, right? The vibes are off with tech. And so at least in the near term, that sustainability lens is not a driver of performance. What do you say to that?
I mean, I think if you look at it on a 1 to 2 quarter basis, we wouldn't expect it to every single quarter be the driver of performance. It's really looking at it over, a 2 to 3 year basis, or potentially longer, that it's going to be a driver, we believe, about performance. And there's a lot of factors that we're considering that are looking out 2 to 3 years. We're not saying, for example, by incorporating ESG risks, we wouldn't invest in a company that has a high level of ESG risk, for example, not because we think in the next quarter or two that's going to play out in terms of financial performance, but because we think in the next several years it might.
And where's the demand for your funds coming from? I imagine, like a pension fund or somebody managing money on behalf of constituency, where maybe there's more stakeholder involvement. Is that where you see kind of these funds satisfying the need? Also, of course, outperformance. These people want to outperform. But when you talked about the interest, right?
Yeah.
Who is interested? Sometimes there's a lot of people that are interested. Who are the steady stable of clients that are always interested in this kind of investing?
I think we've seen a lot of interest from foundations and endowments, people who actually have a mission, also from retail investors that just kind of understand that concept. I mean, they're off working at these companies themselves. They understand the importance of corporate culture. They understand the importance of risks and considering those for the long term. So those tend to be the most interested clients and the most sticky clients we've found.
Now, talk to me about, are there any sectors that are on the no-no list. Would you ever invest in oil and gas?
So we haven't yet. And that's just to say that there are a lot of negative environmental externalities with oil and gas currently today. I don't necessarily think that that's something that will be something we never invest in, for example. I think a lot of companies are sort of moving their business model away from the dependency of oil and gas, and that's a real opportunity. But for now, anyway, that's a sector we're not invested in.
What do you mean negative environmental externalities? Like just the fact that it's emissions producing?
Exactly. It's emissions producing from a third scope 3 emissions. Thank you. But also, if you look at the extraction, for example, there's a lot of negative environmental impacts that come from that. The companies that we might be more interested in are those companies that are minimizing those environmental impacts. So, companies that sell to the oil and gas, sell their products, for example, to make for more prolific extraction that's less environmentally impactful.
Now, stress testing this idea of, the dollar has no conscience, these companies, a lot of them have proved to be quite sustainable, like Exxon's, just to use that has decades and decades of experience, of history, I should say, and a moat. So I guess you can be, in your view, not a good corporate citizen and still kind of endure, right? And I'm not saying that Exxon's not a good corporate citizen. Okay, Exxon. But like, it seems like if I were to apply your language and your worldview, it leaves out a stock that has existed despite your thesis.
I think any investment manager has to kind of narrow down their investment opportunity set, right? And for us, it's really looking at long-term secular trends on the idea the market's underestimating the growth opportunities coming from them. I just don't see oil and gas as a long-term secular trend. So being able to kind of identify those companies that do have secular trends behind them and supporting them, we think those will see above average economic growth. So those are the type of companies that we want to invest in. That's not to say for some short period of time, even for a couple of years, potentially oil and gas companies are attractive investments. We just think that, given our process, understanding those secular trends and the companies addressing them will lead to better outperformance.
What about mining?
Not an area we're invested in either.
I think I could have told. I could tell, but yeah, I think it's important for people to kind of understand. Is it a similar sort of view that the extraction, the process, environmentally damaging?
Yeah, I think if there were companies that we felt did it in a more environmentally less impactful way, those were companies we'll invest in. And I think we have a global emerging market strategy, for example, that does invest in a mining company because it does it in a less environmentally impactful way. I think there were kind of, if you look at sustainable investing or ESG investing or whatever you want to call it, there were a lot of kind of no-nos for a while, right? Nuclear, nobody wanted to invest in nuclear weapons, for example. So I think the industry as a whole just needs to be adaptive and recognize that we can't look at the world the way we want it to be. We have to look at the world the way it's going to be and really identify those companies that are doing it in a better way.
Speaking of the way the world is going to be, there's no way to get around AI. And we're going to talk about a lot of ways to invest in that. But since we're talking about, power and energy, I'm curious how you think about a renewable sector, because I don't see it immediately in your top 10 holdings. I know we've seen a bit of a come back to life, a little bit of the solar sector in the US. But talk to me about why isn't renewable in your top 10?
I think that, from an opportunity perspective, obviously this AI power usage needs to be sourced from something. And I think renewables certainly going to be a piece of that growth opportunity. It's just really tough to find a high quality company within the renewables space. It's very commoditized. You have a lot of competition. You have these boom and bust cycles. So it's really tough to identify companies that you want to be owners of over the long term within that. GE Verona is one that we own, not a renewable company, but certainly uses them as a input into their sources of energy. So I think that there's some better ways to play it in more high quality companies.
This idea of sustainability, I would love to know what conversations you're having around how you apply it to AI. Right? Like around the ethics of AI, the power consumption of AI, the output of AI, what it could do to humanity. These are really big questions I don't expect that you have the answer to. But I imagine if any fund is going to tackle that first, it's a fund that has a sustainable investing lens?
So from an AI perspective, obviously, there's a lot of risks associated with that and a lot of unknown risks, right? We have no idea what that's going to do with regards to how this all develops over the next 5+ years and the risks that come out of it. So it's, I think, really just understanding what the risks can be, understanding what companies are doing to address those. But again, it goes back to that point where we can't look at anything and say that this is how we want it to be. This is how it is. So let's understand those risks. Let's understand what's priced in, and let's identify those areas that we think are good opportunities to invest. So all of it is very unknown. And I think that all I hear now is AI, but there's a lot being figured out still.
I'd love to know, what are some of those questions that you're asking when you're saying, we need to understand the risk? I mean, I see so many essays being penned about these dystopian futures that we could potentially be in for. I'm optimistic, so I like to think that none of that's going to happen. But from an investor perspective, what are the right questions maybe to be asking of your AI companies today?
Yeah, I mean, I think from our perspective, what we're trying to understand, what job loss being one of them, right? How do other companies adapt? And I think we've seen a lot of kind of investors jumping to conclusions already with regards to like the software complex, for example, and all of those companies being essentially assigned a zero terminal value today. So it's really understanding how AI can be used in existing company business models, whether that be to drive revenues or to cut costs, and then what business models become obsolete as AI grows. I think that that's really our opportunity and our risk as investors to focus on.
It's interesting you mentioned job losses, and the market kind of does this very unpleasant thing whenever there are job loss announcements, right? The stock tends to rally, although that must be terrible for morale, when those things happen at those companies. And then, part of the optimism around AI is all those efficiencies, which are, again, job losses. How do you plan on ring fencing, your views on corporate culture with the disruptive nature of AI?
It's a tough challenge, I have to say.
Yeah.
Because at the end of the day, AI should make some types of jobs obsolete, right? But I think it's kind of an opportunity for upskilling, for example, and making sure that people are adaptive to this changing environment. And I remember too, when we had automation start to become more popular in robotics, it was, everybody's going to lose their job. That didn't happen. Jobs changed for sure, but I mean, unemployment stayed roughly where it is. So I think that typically will be what happens with AI. At the end of the day, humans aren't going to invent something that basically replaces themselves, I don't think. So I think that there's an opportunity for upskilling, for example, and really looking for companies that are providing continuing education, for example, becomes an opportunity, I think, for them to improve the culture, help upskill their employees, and really make sure that there's less redundancies.
Okay, well, let's find out how we're going to apply all of this and talk about it through some stocks in the mailbag. Okay, the first question in the mailbag is Nvidia, which is your top holding, I believe across multiple funds that you manage. What do you think about Nvidia? Well, on one hand, it just hasn't moved in a while. It is set to report results this week, which used to be a very exciting event. People would gather at bars to watch Nvidia report. I don't know if we're doing that anymore. How do you think about Nvidia as a stock right now? And then after you answer that, I'd love to know what sustainable investing layers you place on top of that.
Sure. So yes, as you mentioned, it's one of our biggest positions. This should be an interesting week. I might need to find one of those bars where you watch earnings come out. I think if you look at investing in general, it's kind of knowing what you know and knowing what you don't know. I have no idea how big AI is going to be. I've consistently underestimated the opportunity there, I think. But I do know that NVIDIA's best way to play it. I think they have a dominant market share. I think they have a durable competitive advantage. Yes, they'll start to lose some market share over time just because none of their customers want to rely on one single supplier. But I do think that they have durability with regards to their competitive advantage. And it's not an expensive stock. I mean, you look at it in a PE multiple basis, it really just doesn't scream expensive. So I continue to like NVIDIA. As you said, it's been kind of a flat stock. But I do think if you look at kind of the last few years, it's growth's been exponential, both in terms of its earnings as well as its stock price. So some kind of time to recap and rethink and consolidate isn't necessarily a bad thing. And hopefully Wednesday night it starts to grow again from there.
You mentioned market share. Do you think this stock can continue to work even if it cedes some market share? If Google wants to use some of its war chest to make its own chips and sell to others, because you spend so much time around moat, what are those soft factors around Nvidia that make it difficult to disrupt in a total way?
Yeah, I think they just have phenomenal innovation, and we've seen that really throughout their life cycle. They obviously have scale as well as just strong relationships with customers. And I think from a fundamental perspective, the stock can continue to work if they cede market share because their earnings are going to continue to grow. The stock's going to get cheaper if the stock price doesn't move. At the same time, what we've seen, I think, in the market today is just so much sentiment and so much crowding and so much fear. So I do think that, there is the potential for the stock to underperform, even if the fundamentals continue to work on this idea that the market share is going to continue to shrink. So it's been a really challenging market, I would say, the last few months to actually focus on fundamentals and be a long-term investor because nobody cares. But I do think, if you're thinking over the long term, I think it's an attractive proposition today. But that's not to say it's going to go up in a straight line. And we've seen that with a lot of stocks.
Now, another stock that has been sold off and is kind of a victim of this AI trade in software is Salesforce. Salesforce also reports, and we got a question about this from Sean. Do you think Salesforce has upside after the SaaS scare, the software as a service scare? And that seems to be the key debate on Salesforce because they also have their own AI tool. And there's questions about uptake around that. Is it going to be disrupted or aided by AI?
That I don't know. I do think it's been interesting to watch these software stocks and quite painful, to be honest, in that essentially investors are taking this view that all software stocks have a zero terminal value. And I just don't think that's the case. I think that there's companies that need software stocks for transparency, for trust, that have deep relationships. And these vertically placed software companies, I think, are actually well positioned to use AI to continue to maintain those relationships and grow over time. The market, in my opinion, has taken something of a lazy view of software stocks where it's like they've all just sold off regardless of how ingrained they are with their customers, regardless of how important they are, regardless of how likely they are to be disintermediated by AI. So I think if you look at Salesforce, for example, I think that there's some opportunity for them to use AI to continue to better their product and keep customers. I do think that there's a little bit of risk with regards to some of their products and the ability for those to be taken over by AI. It's certainly a lot of uncertainty in general, I would say, around software stocks, but I think that's your opportunity as an investor.
Yeah, which one would it sounds like you don't have the conviction around Salesforce, but is there a glaring obvious buy right now in software?
One that we like a lot is Tyler Tech. So basically they work with governments to essentially, like if you're going to pay your parking ticket, you can do that online, for example. So I think governments are, I probably shouldn't say this on a podcast, but probably the slowest to move. So I think that they, basically go out to, the police department and the fire department of all these towns and they build these relationships. I just don't see that being necessarily replaced by AI. It's certainly not anytime soon.
Tyler Tech. Okay. A nice under the radar name. Ticker on that is TYL, trades in the US. And yeah, even in 2026, it's down 30%. And I assume that's on no news.
No news. They had great earnings.
Okay. Let's switch to medtech. We've got a couple of questions on that. That sector has also been under pressure. Maybe we'll talk about the one that got it worse, which is Boston Scientific. Those results, it was really about the forecast, just a horrific drop in the stock, hasn't recovered, the worst drop we've seen in 25 years. Profit forecast was a little bit light of expectations. This is a really well-loved stock. In fact, it was a top pick from a guest, unfortunately, the day before earnings. So didn't pan out in the near term. But again, if you're a long-term investor, maybe a nice play. So we got a question from Arnie just on what do you do with a stock like that?
Yeah, I think certainly guidance and even kind of a slight miss because they missed a little bit on one of their divisions, which I think hit management credibility as well. Market's been incredibly punitive on just the tiniest miss. And I think that that's an opportunity. That's a stock that we like. We hold it. It's not a huge position in any of the funds I co-manage just because valuation before this was quite high. But I do think
that can sometimes be why a stock gets aggressively punished.
Exactly, when you don't have that valuation support. And that's certainly what we saw with them. But I do think that they have great products. And if you look at their revenue growth and the expectations even after their slightly lower guidance, it's still quite strong. So from a valuation perspective, I think it's an attractive stock. When it starts working, when that sentiment changes, I don't know. But I think if you're thinking at the opportunity, I think now it's pretty attractive.
One of the things that I noted in the analyst commentary, and it goes to something you look at, is the soft kind of social factors, management. Yeah. I think it was a comment from an analyst who said management historically always gets it right. They might stumble, but they ultimately get it right. Is that your view of Boston Scientific? You're from
Yeah, I've met the company.
I don't know if you're at the same clubs or whatever, but it is management like high up in terms of the points that Boston Scientific gets.
Yeah. So if you look at our assessment of culture, they're in the top quartile or top quintile. And I think that they've really built a strong corporate culture. I think that that's probably why the sell-off was so sizable. If you look at what happened, management was talking up these results that were going to come and then they missed on this one area that I think analysts were quite focused on. So that really hit credibility. And I think that that's the bigger part of the problem because management was held to such a high regard. That's certainly an area that I think that they need to kind of repair investor relations with is just rebuilding that credibility.
Now, another kind of medtech company, Intuitive Surgical, I don't know if it's down in sympathy, but it's also down. Is this a name that you would pick up? We got a question from Rebecca on this one.
Yeah, another name I like. I think it's one of those companies that's really innovative, and I think that that's important within healthcare in general. Is just finding those companies that are really leading to a better quality of life. That's a company that's certainly doing that. They have a huge head start on their competitors, and I think that that's an opportunity for them to continue to grow. And I think if you look at these surgeries, and I just had my appendix out a couple weeks ago, and it's like, they make these tiny little incisions, and you're up and out, and an hour after surgery, it's pretty impressive. So I do think that there's an opportunity for that to just lead better outcomes to patients, and I think that they have a durable competitive advantage as well.
Is there any AI concerns, any disruptive AI concerns to this sector? Do you think it's pretty enduring?
To medtech in general, it's. I kind of get lost in all the different narratives on why things are going to go to zero with regards to AI. Last I heard, there was one company that reported, and it was like white collar jobs are going away, so people wouldn't need childcare anymore. It's just kind of silly, but so none that I've heard of or that I can think of. That doesn't mean that they're not out there. I think pharma's probably in the supply chain for tools, for example, and CROs. That's probably a bigger issue, I would think, from AI.
It's interesting because you do look at sustainable investing, and I'm curious how you apply it. What questions are you asking of your healthcare companies? Because there are a lot of ethical issues, a lot of sustainable issues. I'm curious if you ever owned a United Health, for example, or if there were some red flags there that kept you away.
Yeah, we never did. And definitely try to avoid industries I don't really understand the value add. And that was certainly one of them. I think, there's a lot of ethical issues to your point. One of the areas we also typically avoid is pharma companies. Because in my opinion, and this, I don't mean to paint all pharma companies with a broad brush, but a lot of these companies spend, more time and money just making sure they have exclusivity on their drugs than actually thinking about the better outcomes for patients. So an area we typically avoid, and that's not every company. We deal in Gilead, for example, which I think does a better job than most. But certainly that's an area that we focus on with regards to ethical concerns. Things like bribery and corruption, for example, become hugely important for a pharma company.
Okay, and well, this segues nicely. We got a question on a pharma company, Novo Nordisk, which has, seen a stunning fall from grace. It's the Kleenex of diet makers, right? Ozempic. The issue is that other people aren't really using it. They're using Eli Lilly's solution. They just were dealt a blow this week on their injection version of the drug, which wasn't as efficacious as Eli Lilly's. It didn't lead to as much weight loss. Is Novo in the penalty box for pharma, or is that one that you'd look at? I don't know. Ethically, is it good? Is Ozempic good for humanity?
Yeah, that's a whole nother question if it is. But I think we did own Novo for a while, and I was willing to defend it in that, you had these weight loss drugs and the growth there. And yes, they had the second best drug out there. But at the same time, the market was going so quickly and that valuation was just so inexpensive. And it's just one blow after another with that stock. It's just, it got too painful. We ended up selling it.
Okay, too painful to get into Novo. The last one in the mailbox, and it kind of brings us back to software, but in cybersecurity. Wondering about Palo Alto Networks, down more than 20% over the past year. Any thoughts? This one coming from Arthi. And it's so funny because everyone always says like cybersecurity is just one of those non-optional things. But the market, I guess, is treating it as optional.
Yeah, I think, again, it comes down to, can AI make a competing product with all sorts of vibe coding and concerns around that? Again, cybersecurity is going to be incredibly important. It already is. But you think about how much data is collected on people and how important it becomes to protect that data. Cybersecurity just is non-negotiable with regards to companies' ability to really protect that data. But it just becomes the question, are there going to be risks if Anthropic, for example, comes out with a product? And I think that's
like
really
an additional layer.
Exactly. That's the overhang. And I don't know the answer to that, to be honest.
So you're not dipping your toe in.
We're already in a couple of strategies in Palo Alto.
Yeah.
On this idea that cybersecurity is incredibly important and you're going to go with a company that you trust. And Palo Alto clearly has a strong relationship with its clients. So another one, again, software in general, it's just been so painful.
It's been painful.
But one that
I started vibe coding. It's actually quite, it's amazing. But I'm like,
it is.
It's basically if you were to imagine a website, and I obviously don't know how to code, and I just typed it in and I said, can you make this?
Yeah.
And then it did. And I was like, wow, it just seems like one of those light bulb moments where I think one of the platforms, like the main hurdle to putting up a website is that you don't know how to do it.
Yep.
But what happens if everyone knows how to do it? So could be an interesting wave of innovation.
Yeah.
At the expense of coders.
At the expense of coders. Yeah. I think that's why Shopify, Canadian company, has been so hard hit.
That's right.
So.
Yes. Okay. We are going to dip into now your pro picks. You've brought us your high conviction ideas. You're not sure about a lot of names in the mailbag, but these 3 names you've got conviction on. So let's talk about those. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, your first pro pick is On Holdings. Running shoe company. You're a sustainable investing investor. So I'm curious about the growth you see at On Holding and why it's so good from a sustainability perspective.
Yeah. I mean, I think if you look at kind of COVID and people started actually taking care of themselves a lot more, and we see that with younger generations too. So it's really that idea behind well-being and people getting out there and moving and running and walking. And it's just a company that, took advantage of Nike's missteps, taking their products out of the retail channel, for example, to getting retail shelf space. And I think that that's been their opportunity. They have a really strong brand now, but they also have really low brand awareness, which provides that opportunity for growth, I think. It's a company that, the market really hasn't assigned any sort of sustainable growth profile to from a multiple perspective, but they've been blowing away numbers and they have an opportunity too in clothing, which I don't think is really in anybody's long-term numbers. So just a company we think is really well positioned to take advantage of that wellness trend to continue to gain market share and improve their brand awareness. And then from a sustainability perspective, I won't say it's the most sustainable company out there, but they do some really cool initiatives where essentially you can do like a leasing of sneakers, for example. So you get these sneakers, you have them for 3 months, they take them back, they completely recycle them and send you a new pair. And they have a lot of recycled materials in their sneakers, for example. So some really cool initiatives that they're doing on the sustainability side of things.
Now you have to marry that with what's going on with the consumer. You mentioned Nike. Other athletic apparel makers have also struggled. Can all of those factors exert a force against the physics, which is we're worried about the lumpiness of the consumer?
The consumer right now is a really interesting picture. I think we have kind of this K-shaped consumer, right? Where you have the high end that's actually doing really quite well. And then you have the lower end that's really struggling with things like inflation. So I think avoiding the low end on the consumer side of the spectrum is where you want to be right now. So really focusing on those high-end brands, focusing on durability with regards to brand equity, I would say is incredibly important right now. Now, we have to keep an eye on the consumer over time because obviously there's a lot of pressure, not only on the low consumer, but on the high end as well. So, but with tax cuts coming in the US, for example, with a still decent stock market and house prices holding up, I think the high end consumer seems to feel okay.
Your second idea, and I think this one is a little bit controversial just because it's down and out so much. It's called Bright Horizons Family Solutions, ticker BFAM on the New York Stock Exchange, childcare centers. It's down 30% so far in 2026. Let's first talk about the business and what's attractive to you about the business, and then we'll understand why it's been under pressure.
Yeah. So Bright Horizons has a business model where they typically partner with corporations, and then those corporations offer their employees subsidized daycare. So it's a huge benefit to the employee because you guys are in Canada, but in the US, daycare is just incredibly expensive. So
same here too.
Okay.
So one thing that isn't amazing.
Gotcha.
Yeah.
So it's really the opportunity to provide employee benefits and really retain employees, and also provides for gender equality, and that a lot of times women just don't come back to work because it's too expensive.
Of course.
So it's a high ROI for the company. And they've essentially evolved their backup care as well. So for example, you couldn't bring your child to daycare, their usual daycare, or your nanny couldn't come in. You can essentially bring it to one of those backup care centers. And that's actually a much higher growth business for them and a higher margin business for them. So that's really what the company does. They also have an educational advisory, so college planning and things like that.
And then their earnings come out, the stock plummets. They're closing a bunch of underperforming centers. So that all sounds amazing. I'm rooting for it as a working woman, for it to work and for women to have kind of that equal setup. But what were the missteps in the quarter with the company's strategy?
Yeah, no, the quarter itself was great. I think they just guided conservatively, and that spooked investors. The biggest issue for them has been their full-service daycare center. And obviously, they closed 85% of their centers during COVID, and occupancy has been ramping back up, but not to the same extent it was pre-COVID, hence the closing of their centers. So I think that as they start to close centers, as we start to see kind of that low single-digit opportunity on the occupancy as well as the pricing, that's an opportunity for them to really return to where they were pre-COVID, which was this 8 to 10% top-line grower, 50 basis point of margin improvement every year, and you had double-digit EPS in the market, like that consistency. So it's really getting back to that consistency, I think, that causes the stock to work. But the conservative guide for 26 didn't help, obviously.
But maybe an entry point if they can hit their targets. Okay, your third idea is a stock called Autoliv, ticker ALV on the New York Stock Exchange. They make safety systems, seatbelts, airbags, child restraints, things like that. What do you like about it?
Yeah, obviously there's a cycle within autos, but there's also a bit of a secular trend with this one, particularly in emerging markets. Mm-hmm. So you look at the increased regulation around safety content of vehicles. It's starting to increase in emerging markets. They're also putting safety content in 2- and 3-wheeled vehicles. So motorcycles, for example, start to have airbags, which obviously I think is an opportunity to save lives.
Is it going to help? Okay. I think I need to see a simulation of what that looks like.
I'm sure there's one online somewhere.
Yeah. Okay, but as you mentioned, there is an auto cycle, and it's customers like Stellantis, Toyota, Volkswagen. Not all of them are doing amazing. But Autoliv has held up as a stock. So how has Autoliv been able to decouple from some of the issues that maybe its customers are having?
Yeah, again, I think it's that secular trend. They're going a bit higher than the industry. So that's really been helping the stock over the years. Also, it's one of those things where there's not a lot of competition. You're not going to, if you're an auto OEM, for example, switch your safety system to something that doesn't have a brand and a proven track record. Last thing you want are your airbags failing, for example.
Is this a sector, because it's manufacturing, that is affected by tariffs at all, or?
Yeah, it certainly ties into the auto industry and the effect tariffs have had, for sure.
All right, Amber, thank you so much for joining me. It's been a pleasure chatting with you.
Well, thank you.
That's Amber Fairbanks joining us from Impax Asset Management. Don't miss our next episode. We've got Rebecca Telscher on the show. She's talking dividend paying and value stocks. She's of New Haven Asset Management. If you've got questions, we'll see if she's got answers. Email us questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod. And we'll see you on the next episode.